When you think of asset allocation, you want to try to match time horizon, which I've spoken about on another occasion, with what works over varied time periods. So what this means for most people is a trade-off of return versus volatility, or the potential for downside risk versus upside return. When we look at very long time horizons, people that might have a 20 or 30 or even longer time horizon, you just simply ask the question, over very long time periods, like 20, 30, 40 years, when we look at rolling history, what's done well, what's done badly, and if you've got a long time horizon, you want the things that do well. And the irony of that is that it's such a simple concept, most people can't get it. You got a very long time horizon, you want a very heavy orientation towards stocks, because in rolling 20 and 30 and 40-year periods, nothing does better than stocks. There is no liquid asset class that can beat that. The only real way to beat that is to take big risk by doing something in the private sector away from public securities, and that can blow up in your face and doesn't actually necessarily provide you what you need to get there. The way you accomplish the goal is stocks. If you have a short time horizon, however, stocks are volatile. And there's a pretty high likelihood, if you have a 3, 4, 5-year time horizon for whatever you're doing, that you shouldn't have much, if any, stocks at all, and it should be mostly fixed income, because you need that money then for sure. So it really comes down to short time horizon, heavy orientation toward fixed income. Long time horizon, very heavy orientation toward equity. What about in between? Once you start getting shorter than about 20 years, down into 15 and 10-year time horizons, you start blending in fixed income with equity, so that you might start off with a 85% equity, 15% fixed at something like a 15-year time horizon. At a 10-year time horizon, it might be more like 70-30 or 65-35. But the shorter the time horizon, the more fixed income, the less equity, to stabilize the returns. Not for the income, but to stabilize the returns. The longer the time horizon, the more you want it to be straight out pure equity.